Okay, guys, like I was saying, welcome to our week 4 and final lecture. Like I always say, it's hard to believe that we're in the last week already. The 4 weeks just flies by. And the good thing with last week is the only thing you have this week is your assessment, which isn't a word problem or anything like that. It's just an objective exam similar to weeks 1, 2, and 3. It is long. I think it's like 60 questions. So we will go over that tonight, but that's the only thing you have to do this week. So tonight we'll go over the PowerPoints, going over worksheets, and then we'll also go over that assessment. Typically, I know I taught this class before, and it actually wasn't. That's why I was surprised it was an objective exam like that, because when I taught the class before, the final was like an assignment, building a worksheet similar, which is what we're going to learn tonight. So I don't know which one's better, the assignment or the assessment, but I know they switched that around a little bit. But like I said, I always give you pointers as what to expect and everything. It's just going to be long going through that whole assessment, but we'll get through it. So like I said, do you guys have any questions before I start class or anything? Okay, good. So, also note that, the last day of class, and you see I have my calendar up, is July 11th. So I can't stress enough to get all your work turned in by July 11th before 11:59 p.m. Mountain Time. And you see me reference that date probably in every announcement this week, so you're probably going to get sick of hearing about that date, but I always stress it because there's no leeway in turning in late work past that date because that's a school deadline, and it never fails. I always have at least one person every class who seems stunned or doesn't know about that deadline and tries to turn in work past it. But so I always stress it, and you know me, I'm usually lenient with late work, turning in past deadline, but I have no leniency for that date just because it's a school deadline and they strictly enforce it. So please be aware of that deadline and just get all your work in before July 11th. And, as I always tell everyone, no, it's 11:59 p.m. Mountain Time. Everything's always Mountain Time. So that would be, what time would that be my time? That would be like 1:59, 1:59 a.m. So as I always tell everyone, it's probably wise to get all your work in, or at least start it like by Wednesday or Thursday of this week, because if you start your work, and again, I always have I get a flurry of emails Friday night or Saturday, because people will start Saturday, and they say they have computer problems or something. Their computer crashes Saturday when they're trying to get all their work in. Unfortunately, that's not a valid excuse. I mean, if your computer crashes, I hate to say it, but you should have started your work early. I know that sounds harsh, but like I said, they really enforce this Saturday deadline. So that's why I always stress it, that there's no leeway past that. So, that's why I always say try to get your work in Wednesday or Thursday of this week, just in case you do have a computer malfunction. You at least have a few days to figure it out as opposed to rushing around Saturday. Because more than likely, if you email me at 11 p.m. on Saturday, keep in mind that's 1 a.m. my time, so more than likely I'm not going to be available. Yeah, and you have all week. I'm getting you the lecture on Monday, but it never fails. I always have one person who seems dumbfounded by that date. And like I said, I would be lenient, but it's not my call. It's the school's call. So just get all your work in before that date and you'll be fine. That's what I always say. And like Linda said, you have a whole week to do this because you're getting the lecture posted today, Monday. So you'll see that date. I'll be referencing it constantly, and you guys will definitely be getting annoyed with me saying it, but it's how I try to get it through how important that date is. But I always stress that at the beginning of the week 4 lecture. So with that said, for week 4, we're going to look at chapter 5, which deals with worksheets and adjusting entries. So the only thing you have this week is the final exam, which we will go over, which that's going to take the majority of the class. The PowerPoint is probably honestly only going to take 10 minutes. It's not that long. And then the rest of the class, we're going to focus on the final exam, giving you pointers and everything. So the only thing this week you have is the final exam. Of course, you have your daily checkpoints, make sure you do them in this final week, but the only other graded work is this final exam. You have no assignments or anything. You don't have a graded discussion. You have an ungraded discussion, which again, you don't have to take part in, but if you do, I appreciate everyone who does, but if you don't, you're not going to lose points or anything. It's ungraded, doesn't affect your grade, but if you also don't want to put your reflection in the discussion, you can always email me, or I know you guys have surveys at the end of the class, so you could always do your reflection on there. So there's multiple ways to give me feedback, but this in no way affects your grade if you don't participate, because I know everyone's busy, so I understand if you can't participate. So chapter 5, let's look at the PowerPoint. Like I said, this is a smaller PowerPoint. It's only 13 slides, and it's dealing with worksheets and adjusting entries. So just to give you an example of what a worksheet looks like, this is, I believe it's the fourth step in the accounting cycle, which there's a slide later that outlines that. But this is the 4th step in the accounting cycle after you post data and create the trial balance. So from last week, if you remember, we did journal entries, we posted to the ledger, and then we completed a trial balance. Now we're going to complete a worksheet. So you'd simply enter the trial balance information here, which actually, let me go to the next slide. To put a trial balance, it takes 4 steps. It's just copying the information. You enter the general ledger account names, transfer the debit and credit columns, total them, and do a double rule at the end to show that they equal. So that's all you're doing for the trial balance. You can see on a worksheet. You're just literally, after you complete the trial balance, you're putting it over here on the worksheet. And then if you have any adjustments, you can see in the next column, this is where you put adjustments to the trial balance after it's completed. Like for instance, a typical one is depreciation, which you can see they have an adjustment there for depreciation. At the end of the year, if you're going through your accounting records and you see depreciation wasn't booked correctly, or you have to square it up based on the tax return, then you do an adjustment to depreciation. Like let's just say for all intent purposes, you can see on this trial balance, there's no depreciation, but going through your records, you see, there should have been $183 in depreciation book. So you debit, increase depreciation expense, and then you'd credit, decrease accumulated depreciation, because accumulated depreciation is a contra account to equipment, meaning it works in the opposite way. So that would decrease your asset on the balance sheet. And you can see the other adjustments they have here are to rent and supplies expense. And that supplies expense goes hand in hand with inventory. That's another one that's a common one, inventory. Like say, for instance, at the end of the year, you have $1,500 in inventory, but you do a physical count after year end and you notice it should only be $1,000 in inventory. Well, that means you have to make an adjustment to equal your physical inventory on hand. Well, of course, if your physical count is off from your books, then you want to look into it. But let's just say, you looked into it and it should be $1,000. You just forgot to record something. So in this case, you'd have to bring down your inventory, your supplies, by $500. So remember, you'd credit supplies because supplies is an asset, which means it has a normal debit balance. We want to decrease it, so we want to credit to decrease it to $1,000. And then the offset, you would expense. You would run it through to the P&L and increase your supplies expense by debiting it. And the other one they have on here is prepaid rents. Again, that's another one that's sometimes an adjustment because people will tend to book prepaid rent incorrectly or forget to release it appropriately in the year. Contra account, you hear that just meaning it works in the opposite way. Like on your balance sheet, you'd have equipment and accumulated depreciation equipment. And my little video's coming up, sorry. You'd have on your balance sheet equipment and accumulated depreciation equipment. And what I mean by contra account is accumulated depreciation will show as a negative, equipment will show as a positive, and you net those two together, just showing, accumulated depreciation decreases your equipment, which the net of it gets your net asset, net book value, net asset, net book value. And let me see if there is a balance sheet in here showing that. And of course there isn't, but it would be like this. It would show equipment, 10,817, and then under it, it would have accumulated depreciation, negative whatever, just say negative 1,000. And then you'd net those two together to get total equipment of 9,817. Just what a contra account means is it's working in the opposite way on the balance sheet to decrease your asset or liability or equity account, whatever it relates to. Which slide was I on? Number 4. So another one, did that make sense with the contra account? I know it's a little confusing at first. Okay, good. So the other adjustment they have on here is prepaid rent, which that's a typical one. You forget to release your prepaid rent in the year. So again, let's say at the end of the year, you have $8,000 in prepaid rent. You find out, oh, I should have expensed $4,000 of that. So in this case, you have to move it from the balance sheet from prepaid rent to the income statement and expense it. So in this case, if you want to decrease your prepaid rent by $4,000, you have to credit prepaid rent for $4,000 because again, prepaid rent asset, normal debit balance, increases with debits. We want to decrease it, so we want to credit it. And then the offset, we're going to increase debit our expense to recognize the expense. And again, these aren't limited just to these adjustments. It could be any adjustment that you make. Like I said, you could have adjustments to accounts receivable, you could have adjustments to accounts payable. It just depends on what what accounts you have to adjust. Like, for instance, when I did the audit reports for my one company, typically I would have to adjust a lot of like tax accounts to square up to the tax return, square up like the income accounts when we were accruing or estimating our income based throughout the year, but then at the end of the year we square it up to actual. Same with expenses. I mean, it just depends, but that's why they use these three as the common examples, because a lot of times depreciation is your main one that you square up. And then I don't know, okay, they're going to continue on the next slide. Okay. And then, like I was saying, it's the fourth step in the accounting cycle. I referenced that earlier. It depends. I mean, there's so much that goes into business and personal use of the car. I mean, it's not like, it's like a tax question. It always depends. Same with accounting. It always depends. I mean, I know that's not the best answer, but it's it just depends, really. Like I said, I'd need to know, there'd have to be more information. Like I said, a lot of times if it's a lease, it's based on the lease values by the IRS. A lot of times you wouldn't do an estimated percentage because that's typically an item that the IRS is going to audit if it's estimated, if it's incorrect. I know there's rules in the IRS handbook dealing with mileage, but I can't remember them off the top of my head. I always have to look them up because they do leased cars and cars through the business, and there's some rule with the IRS how to govern that. But this is the slide that I referenced earlier, the accounting cycle, the worksheets, the fourth step, preparing a worksheet. So I showed trial balance and the adjustments. Now we're going to finish preparing the worksheet. So we put the trial balance in there, we put the adjustments, and all you do now is you create an adjusted trial balance. So you just add, your beginning trial balance plus or minus your debits or credits. Like you can see, cash has no adjustments, so the debit balance is a debit balance. Same with accounts receivable. Supplies, it has a $1,500 debit balance. If you have a $500 credit, then the net is $1,000. $1,500 minus 5. $8,000 minus 4, $11,000 minus 0. You're just adding and subtracting the adjustments to arrive at your adjusted trial balance. And then, of course, after you do that, you want a total to make sure your debits equal your credits. And they do in this case, 156A3, 156A3. And as I told you the first week of class, the main goal of accounting is to produce financial statements, the income statement and the balance sheet, which you can see are our next columns. So now the next step is you're going to take your adjusted trial balance and put it in either the income statement or balance sheet column. Remember, income statement is revenue and expenses, and balance sheet is assets, liabilities, and equity. So you have to know which accounts are assets, liabilities, and equity, which accounts are revenue and expenses. And you can clearly see fees, income, that's revenue, and then all of your expenses, they have expense after them. So all these accounts you can see are being put in the income statement column. Assets, cash, receivable, supplies, prepaid rent, equipment, accumulated depreciation equipment are all on the balance sheet. Liabilities, accounts payable on the balance sheet. Capital and drawing, your equity accounts, are on the balance sheet. And then you would total them, and you can see your debits don't equal your credits, which makes sense because the next step, remember what I told you in, I want to say it was the first week or second week of class, income statements accounts are called temporary accounts, meaning they get closed out at the end of the year and rolled up into the balance sheet. And that's what you have to do in the last step. If we go to the next slide, you take, and let me zoom in, you take your revenue, 47,000, minus your expenses of 13,333 to get your net income of 33,667. Because if your income is higher than your expenses, that means you have a net income. If your income is less than your expenses, you have a net loss. So in this example, we're looking at a net income. So what this is doing right now is it's taking your net income and it's rolling it up into the equity section of the balance sheet. Because just think of it from, what's the word I'm looking for? So if you made $33,000 in your business, you'd roll that up into your equity account. If you made $33,000, your equity is going to increase. So remember, equity, your capital account, has a normal credit balance. So that's why we're crediting the balance sheet. Now, if you have a net loss, you'd want to debit the balance sheet and credit the income statement, because if you have a net loss, that means it's reducing your capital account. Remember, to reduce capital account, you want to debit your balance sheet, your equity account. So again, sometimes that's difficult for people to understand, but remember, the whole concept is at the end of the year, income statement or temporary accounts, you need to roll these up into the balance sheet into your equity section. And that's what this is doing right here. It's saying, oh, your company made $33,000 at the end of the year. Well, we need to close those and roll it up into your equity account on the balance sheet. If you lost $33,000, you'd credit the income statement and then you decrease your balance sheet. And that's what the next slides are going to show. Remember, your main financial statements, your income statement and balance sheet. You can see from that worksheet, you build an income statement, which is just taking these numbers. You can see 47,8, 655, 4, 183, and putting them in to income statement format. And there's your net income of 33,667. And you can see we're rolling this up into the equity account, which is on the balance sheet. So you'd add your net income to your beginning capital, take out your withdrawals, get your increase in capital, add it to your beginning, get your ending capital, and then this ending capital rolls up into your balance sheet. So remember, as we saw from the previous week, you build your income statement first, then your statement of owner's equity, then finally your balance sheet account. And then this is just a more expanded version of the balance sheet. Like this is a condensed version, account form. and this is more of an expanded report form. And this is typically how you see the balance sheet, straight up and down like this. Typically, no one ever puts the balance sheet in account form. Confused? Makes sense? Somewhat sense? Like I said, the main thing you should be taking away from the class is how the main goal is to build these financial statements. So you saw, you complete the general journal, you post to the ledger, you create a trial balance, you make adjustments, you get an adjusted trial balance, and then you complete these financial statements. That's the main thing. And the good thing, like I always say, when you use an accounting software, if you do a journal entry, the software automatically will post to the ledgers, create the trial balance, and create the financial statements. So, I mean, it's still important to understand the mechanics in case you make a mistake, but you saw the homework from last week, how tedious that was. You will never have to do anything like that when you work for a company because everything's automated behind the scenes. And that's why, like I always say, accountants focus more now on financial analysis, reading financials, because the data entry is so streamlined. That's why you read articles, saying how, an accountant's job could be done by like robots. You see a lot of articles like that, but they're only talking about the data entry piece. What could never be done is a financial analysis, understanding the accounts and finding mistakes. That's what's going to make you marketable, is how to read these financial statements and interpret them. Yeah, I mean, the T accounts are just there for, like, essentially what a T account is the first steps to help you understand the normal debit and credit balances. But a T account is essentially another form of a general journal. Like, T accounts are just there to help you. But again, in the workplace, you're never use like a T account or anything like that unless you're, trying to figure out an account balance. Like if you're looking at the financials and looking at general journals, you might work backwards and say, okay, well, if, make a T account on a piece of paper for cash and say, well, if I debit cash for $9,000, this is what it's going to do. If I credit it, this is what it's going to do. Like, T accounts are just there to help you understand, but in the workplace, it's not like you're going to turn in T accounts or anything like that. The majority of your work is going to be done through general journals. I think actually, yeah, that's what a ledger is. Like, actually, if I just, let me see. I have a fictitious, not fictitious, just that was a bad word to use. I'm teaching another class called QuickBooks for another college I teach at, and I just made up a company to do random entries in, but I'll show you what I mean. Let's see. Yeah, ledger account, that's just essentially a listing of all of your accounts, and I don't have my little drive in. I just want to show you how streamlined it is, like completing the work nowadays. Like I said, still important to understand the mechanics, but just know that like stuff like you completed last week, you will never have to do because it's done through software. And if you ever work for a company that makes you do something like that by hand, it's probably good to help them implement an accounting software or maybe find another job. So for instance, just to give you an idea, this is just a company I made up because I'm teaching a QuickBooks class at another college. So we just do stuff in QuickBooks. But to give you an idea how easy it is to run reports, company and financial, profit and loss, you can change the dates and it generates your profit and loss for you. Same with the balance sheet, company and financial, balance sheet. And you can see your net income is 13,55605. 13,55605 rolls up into the balance sheet in the equity section. And if you drill down on these accounts, like PNC, this is your ledger account for your cash. You can see it gives you all of your debits and credits, and then you can drill down further, like let's go to general journal, and it will give you more detail. Like it gives you the debits and the credits. And again, this is just a completely made up company that I did, but you do a journal entry and then it would post to the ledgers for you, and then it would build the financial statements for you. I don't know if, no, let me think of that. I don't know if there's a computerized accounting class at this college. I'm not sure. I know I haven't taught a QuickBooks class yet, but again, that could be taught by someone else. And for instance, if you go to accountants and taxes, oh, there's your trial balance. Builds it for you. And I think you can also do an adjusted trial balance. You can see there if you have any adjustments, and those would be picked up if you do a journal entry and click adjusting entry. It would throw it on this adjustment section for you. I mean, there's probably tons of QuickBooks classes you can take. Like I said, the college that I'm teaching it at is just a community college. Like I know a lot of community colleges will have like random classes like that, but like I said, I don't know if Independence University has a QuickBooks class. They may have a workshop. I'd be surprised if they don't. It's just that I've never taught that one at this college before, that's all. But I'd honestly be surprised if they didn't have one. But I just wanted to show you guys how streamlined it is. That's why to be marketable, like I said, in accounting or business for that matter, learn how to read and interpret these financials, especially if you're a controller of a company. You should know every account inside and out, essentially. Yeah, I will, because I'm curious now, because that is true. I've never taught one before, but like I said, I bet someone else may teach one. I'm going to go ahead and close out of this. Get rid of that, exit out. Any questions on any of that? Okay, perfect. Now we have the dreaded assessment to go over. And it's long, I'll just give you that, but it won't. It's long, but it won't take long to get through because it's all multiple choice questions. So, your final exam, this is the only thing you have to complete this week. So, get it done early and get everything out of the way so you can either focus on your other classes or you can relax, which I don't know what that is, and I'm sure none of you do because it seems like there's always something new each day. But this is a big part of your grade, so it's 180 points in total. You have 2 hours to complete it, so you do have plenty of time because it is 58 questions, so essentially you have 2 minutes per question. That should be more than enough time. And every question is multiple choice. So that's another plus about it. No short answer, no true and false. It's all multiple choice. So it's a comprehensive exam, meaning it's on everything that we learned. So make sure you go back, make sure you read all the chapters, review all the PowerPoints. You should also review the past exams because there's a lot of duplicate questions on here. But as I would say, listen to this last 20 to 30 minutes because they won't be verbatim, but it's a very good indication of what you're going to see on the exam. So, stuff you're going to have to know. Know that the third step in the accounting cycle is to post to the general ledger. The statement of financial position is another term for the balance sheet. You sometimes hear the balance sheet referred to as statement of financial position. The first step in the accounting cycle is to analyze the transaction. All financial statements submitted to the SEC by publicly owned corporations must include an auditor's report prepared by an independent certified public accountant, basically, and you have to get an audit done, completed by an independent certified public accountant. An independent accountant who provides accounting services to the public for a fee is a certified public accountant or a CPA. Remember from week 1, services of public accounting firms include auditing, tax accounting, management advisory services. It does not include investment services. Owners and managers need financial information in order to make decisions. Again, owners and managers need financial information in order to make decisions. Expenses involve the outflow of money or the use of assets. Revenue is the opposite. Revenue is the inflow of money. Expenses is the outflow of money. When analyzing financial statements, types of information that would be communicated would be whether or not the business is profitable, what type of assets the business owns, how much the business owes others. It wouldn't show you how long the business has been in operation. A financial statement would not show you that. Owners' withdrawals, remember that they decrease owner's equity. Again, owners' withdrawals decrease owner's equity. Again, know your normal debit and credit balances, what account increases with what. Like, for instance, when a sell occurs, it's an increase. When a sell occurs, it's an increase to an asset and an increase to a revenue account. So when you sell something, you're going to increase some asset and you're going to increase your revenue account. know the accounting formula, assets equal liabilities plus owner's equity, because there's questions, saying if total liabilities are X, total equity is Y, then what are your total assets? Well, if you know the formula, assets equals liabilities plus owner's equity, then you won't have any problem. Again, a lot of questions giving you scenarios, if your company performs services to credit clients, then you're going to record an increase in asset again, an increase in an asset, and you're also going to increase your revenue. So again, if you're performing services for credit clients, you're going to increase some asset and you're going to increase your revenue. When equipment is purchased with cash, you want to increase your equipment and decrease your cash, because you want to recognize the equipment and you want to decrease your cash to show cash going out the door. In a firm that uses special journals, an allowance given for damaged merchandise is recorded in the general journal. Again, that would be recorded in the general journal. If you return damaged merchandise that was previously purchased on account, then one of your accounts is going to be a credit to accounts receivable, because you originally debited it to show that that person purchased it on account, but if they return it and it's damaged, you have to credit your accounts receivable. Know that sales returns and allowances is a contra revenue account. Again, it's a contra revenue account, meaning similar to how I talked about accumulated depreciation being a contra account to equipment, sales returns and allowances is a contra account to revenue, meaning it decreases your revenue, meaning it will show up as a negative revenue on your income statement. If a firm does not have a sales returns and allowances journal, then the entries for these transactions are made in the general journal. Again, if they don't have a sales returns and allowances journal, then those entries are made in the general journal. If you purchased equipment for X amount of dollars and you issued a check for X amount of dollars with the remainder due on account in 30 days, then you're going to have to credit accounts payable for that amount that is due in 30 days. Like for instance, if the total cost for equipment was $4,000, you paid cash of $500, then your credit to accounts payable is $3,500, because you debit equipment for $4,000, credit cash for $500, and then you credit accounts payable for $3,500. Again, a lot of questions with debits and credits. Like for instance, if you withdraw cash for personal use, then you're going to debit, increase your drawing account, and credit, decrease your cash account, because that recognizes that you took money out of your capital account and you decreased your cash account. So you debit, increase drawing, credit, decrease cash. And when credit clients pay their balances, you want to debit, increase cash, and credit, decrease accounts receivable, because this shows money came in and the customer paid their account balance. When revenue is earned from charge account sales, you would debit, increase accounts receivable, and credit, increase revenue, because that shows that that customer owes that money, but then you also have to book the revenue to recognize the sale. And when there are several entries to one or both sides of a T account, the total of those entries is entered in pencil. That's called a footing. But again, this is saying if you're doing it by hand, again, that would be called a footing. If there are several entries to one or both sides of the account, the total of those entries is entered in pencil. That's called a footing. And I think that question came up before because I remember saying how, no one uses pencil and paper anymore. But again, you still have to understand the mechanics, because understanding the mechanics will help you find mistakes a lot faster. If you have two credit entries of $1,000 and $1,500 to the service fees account, which is an income account, then that means the balance of your account is a credit balance of $2,500. 1,000 plus 1,500. If services are performed for cash, then in T account form, again, we're looking at the T account. If services are performed for cash, then on the T account, you'd have a left side entry on cash and a right side entry for service fees, because that's showing you're debiting cash, left side, increasing cash, and then on service fees, you're crediting right side service fees to recognize the revenue. Debit cash, credit revenue. But in the T account, again, T account is just a more detailed, I don't want to say detailed, and I don't want to say like, it's more of a beginner version of a journal entry. That's essentially what a T account is. So don't get, when you see questions involving T accounts, just think of it as in general journal form. You're also given, some questions where you're given a T account of a particular account, and there's debit and credit entries on each side, and then you have to tell me what is the balance of that T account. There's a few like that, not a lot. Remember that credits are recorded on the right side of a T account, debits on the left. Remember that video. Debits on the left, credits on the right. And actually, there is a matching question that snuck in here. So you have to tell me which accounts have normal debit balances. Those accounts would include stuff like cash, supplies, prepaid insurance, drawing, and utilities. Accounts payable and capital would not have normal debit balances. They're liabilities and capital, so they have normal credit balances. Know that debits are used to record increases in assets. The normal balance side of a liability account is the right side. Again, know your formula, assets equal liabilities plus equity, because there's a few questions, again, that give you a few T accounts, and, it asks you what must total assets be to ensure the accounting equation is in balance. So it will give you an asset, a liability, and an equity. The liability and equity will have a balance. You have to tell me what the asset balance is. There's a few of them on there like that. And this question came up before, which I did not like. Rewriting the fundamental accounting equation. You can rewrite it to make it say assets plus expenses plus drawing. equal liabilities plus revenue plus capital. Oops, and my screen, because I haven't hit my mouse. Again, you can rewrite the fundamental accounting equation to say assets plus expenses plus drawing equal liabilities plus revenue plus capital. But I hate that question because you never hear anyone refer to the fundamental accounting equation like that. What you need to know is it's always assets equal liabilities plus equity. And then you can take it a step further and then say plus revenue minus expenses, because remember, the net of revenue and expense gets rolled up into the equity section. So I always kind of just give you guys that one because I absolutely hate that question. Again, a lot of debit and credit entries. You know, purchase of equipment for cash is journalized as debit to office equipment to increase it and a credit to cash to decrease it. Journal entry to record revenue earned and cash received is debit to cash, credit to fees income. Increase cash, increase revenue. With general journals, know that debits always come first. Journal entry to record the receipt of cash from credit clients on account would be a debit to increase cash and a credit to decrease accounts receivable. Again, remember with journals that debits are always recorded first. And a compound journal entry is a journal entry with 2 or more debits or credits. If you bought a new forklift, the entry would include a debit to forklift expense or in other words, equipment expense of whatever the amount is. Forklift is just another name for equipment. You would debit the equipment or debit forklift to recognize the expense or asset. And again, know in journal entries, including compound journal entries, that debits must equal credits. With posting, remember the account numbers are recorded in the posting reference column of the general journal after each amount is posted. You put that in the post reference column. If your accounts payable account has a $3,000 credit balance, you make entries of $1,000 for payment. That means your remaining balance is a $2,000 credit balance. And know that the general ledger accounts, they're usually arranged with balance sheet accounts first, followed by income statement accounts. And the process of transferring data from the journal into ledgers is called posting. Again, you're transferring from journal to ledger. That would be posting. If you accidentally debited your utilities instead of equipment, then the entry to fix that would just be do the opposite. You debit your office equipment and credit your utilities, which means you're moving it from your utilities to your office equipment. Same with if you accidentally posted something to cash. If you accidentally posted a transaction to the cash account instead of accounts receivable, well, you'd simply debit your accounts receivable and credit your cash because you originally debited cash. Well, now you have to credit it. And if it should have been on account, then you debit accounts receivable. So debit accounts receivable, credit cash. And know that correcting entries, those are required when any error is made in recording a transaction. You know, you always have to correct an error. If an error in a journal entry is discovered before the entry is posted to the general ledger, then the error in the entry should be closed out and the correct data written above it. Again, that goes hand to hand, which, again, you're looking at this from doing this by pencil and paper, and we went over this before. If you're doing it in QuickBooks and you notice that something is incorrect before you close out the month or you record the transaction, then you just simply go back into the transaction and change the account. But if you're doing it by pencil and paper, then you'd simply cross out the entry and put the correct data written above it. The adjusting entry to account for expiration of prepaid advertising consists of a debit to advertising expense and a credit to prepaid advertising. You're simply decreasing your prepaid advertising and moving it to your expense on your income statement. And we're almost done. I know this is probably painful for a lot of you, but again, it's very valuable. We only have about a couple more left, so just hang in there. With the worksheet, the adjustments made on the worksheet are recorded in the journal and then posted to the general ledger accounts. If you're recording depreciation for the year-end adjustment, you debit depreciation, increase your expense, and then you'd credit accumulated depreciation to, because again, that's a contra account, so you decrease your accumulated depreciation to decrease your overall equipment. And on a worksheet, the adjusted balance of the depreciation expense is extended to the income statement debit column. And you're also giving a worksheet similar to, again, different numbers, but similar to this, and you have to tell me what the net income is. So again, remember, net income is going to be this number right here. On the worksheet, the balance sheet columns should balance after the net income is debited to the balance sheet column. Again, they should balance after the net income, I'm sorry, I said debited, after the net income is added to the balance sheet column. And also on a worksheet, the adjusted balance of the supplies account is extended to the balance sheet debit column. And again, you can see that right here. It's extended to the balance sheet debit column because supplies have a normal debit balance and they're an asset, so they belong on the balance sheet. And let me just make sure, because that, I believe, is all them. Let me just make sure I did not miss any. Okay. Oh, there is one where you have to calculate depreciation. So all depreciation expenses is spreading the expense over the useful life of the asset. Like for instance, if you buy a $34,000 piece of equipment, you don't want to expense that in 1 year. Instead, you want to spread the expense over the useful life of the asset. So if you have an asset that has a $34,000 book value and has a $880 salvage value, meaning that's decreases the asset if you ever sell it. So you'd subtract out your salvage value of 880. So that's your new total amount for your asset, 33,120. And if you estimate it has a useful life of 6 years, which is 72 months, 12 times 6, that means per month you're going to expense $460 a month in depreciation. For 1 year, that would be $5,520 in depreciation. Again, for 1 year, that'd be $5,520 in depreciation expense. But there is one question centering around that. And with that said, we got through, again, those are very good pointers of what you're going to see on the assessment. I'm sure everyone is drained after that. But that's the only thing you have to complete this week. So just keep that in mind. You know, again, it's comprehensive. Make sure you've read all the chapters, reviewed all the PowerPoints, review the previous exams, because some of those pointers should have sounded very familiar from previous questions. But again, listen to these, and also, you know, it would help to review all the previous lectures, but also review the last 30 minutes of this lecture, because that's a very good indication of what you see on the exam. Do you guys have any questions for me? Anything? Good, good. Like I said, just keep in mind of that Saturday deadline. If all you have to do is this assessment and you're still feeling motivated after this lecture, then I would honestly just do the assessment as soon as possible, or whenever you feel prepared. Just get it out of the way, get it done, and then the only thing you have to worry about are the daily checkpoints. But if you have questions, as always, email, call, or text me. And if I don't hear from you guys, good luck in the rest of your classes, and hopefully I'll have you for next mod. I'm currently slated to teach payroll accounting, I believe. So if you're set up to teach that, take that, then you may have me for class. So I am definitely not teaching biology, I can tell you that. That I can say is not my expertise. I probably failed that in all honesty. So, but yeah, but accounting too. I've taught that one before. But yeah, questions, email, call, or text me. But I will stop rambling since we are over. And I'm sure you guys have other stuff to do. So I'm going to go ahead and end the lecture. Thanks for a great class, guys. And I will talk to you later. Good luck with everything. And I do see you have a question, Pat. So just go ahead. Okay. See if I can answer it. Somewhat good at Excel. So if you have a formula in the debit credit columns, you are increasing and decreasing a number, and now you want to have that affect a previous number, how do you write that formula? So let's see. I think, is that actually, let me check. So for instance, is this what you're looking for, kind of like a running balance? Like for instance, in the week 3, and this may not be in your Excel template, it may only be in the solutions that I have, but you can see how it takes the beginning debit balance plus the debit minus the credit and does a running total. So if I change this one, it changes everything. Similar to that. Okay, should be good.
Okay, can you hear me now?
Yeah, I can hear you.
Okay, this is better. This actually has to do with the work that I'm doing. So I'm going to tell you exactly what it is. I have a beginning balance. I'm doing an inventory control for another company. I have a balance on the inventory list. Now, it's for chocolates. They make more, it increases that, but they only weigh the whole box. So it's going to include my original inventory plus whatever they've made that day. So I have the formula set up so that when he gives me the number, I plug that into one column, and then I can add or decrease whatever that new balance is going to be. But I'm trying to put that back into what is, I have to use the amount. Let's say I had 1 pound originally. He's making 5 more pounds. Now I have a total of 6 pounds. I need the original column to reflect 6 pounds rather than 1 pound. But what he's giving me for a number daily is what's actually in the box, which includes that first 1 pound. Does that make sense to you?
Somewhat. It'd be
That's a tough one because it's almost a circular formula.
Yeah, it's difficult without seeing the actual Excel sheet, but I understand what you're trying to do with it. Increase one from the other, but like you said, you run into a circular problem.
I do run into a circular problem.
Yeah, that's tough without seeing the actual Excel sheet. I mean, you can always email it over to me and I can look at it.
All right, I might do that. What is your email address? Because I lost that along the way.
It's just todd.falcone, todd.falcone at independence.edu. I think that's my email. Let me just, I'm almost positive that is.
Not Steve Henniger then, it's Independence?
Yeah.
Yeah, it's fun to have to try to remember your own, huh?
I know. I'm almost positive. And it's not even down there. Let me just do this. Yeah, there it is. Todd.falcone at independence.edu.
Okay.
Yeah.
All right, that's what I'll do. I'll send that over to you so you can see what I'm working on.
Yeah, and that will help a lot.
Then maybe you can answer my question. As you can see, everything I'm learning at school, I'm using in his business. As fast as I learn it.
That's good. That's a good thing.
Yeah, it is. Okay, thanks very much, Todd.
Oh, no problem.
Have a good night.
You too. Thanks.
Alrighty, bye-bye.